Okay, great. We'll kick off. So thank you for joining the webinar, and good morning, good afternoon, wherever you are. This is in connection with the Ireland's Finance Bill 2023, which was published on the 19th of October. Many of you will be aware that the bill includes the legislative provisions for the tax measures that were announced as part of Budget 2024, as well as introducing new measures and amendments to the Irish tax code. The bill itself runs to 98 sections and over 270 pages of amendments. The scale of the bill is primarily as a result of the well-signalled new legislation required to transpose the EU Minimum Tax Directive and the OECD model rules and guidance relating to the implementation of Pillar 2, as we all know, the minimum effective tax rate for large groups. The bill also introduced new measures applying to outbound payments, and also the introduction of a new intergroup financing structure. The bill also included some steps in modernising the framework of the taxation for leasing companies. As you may be aware, EY Financial Services, we ran several industry-specific webinars in connection with the Finance Bill. And just in case anyone's in the wrong one, this is for the wealth and asset management industry. So I'm delighted to be joined today by Tamara Farron and Keith Lockman, who both focus on the wealth and asset management industry in Ireland. And just to say that we'll run through kind of the key aspects. There should be a question box at the end of your page to insert questions, and we'll deal with them at the end of the presentation. That's the easiest way to do it. So the agenda for today is we're going to look at the key changes, mainly around BEPS Pillar 2, outbound payments, the qualifying finance company, give a VAT update, not all related to the Finance Bill, and then take the opportunity to look at some other sector-specific items that we thought would be worthwhile mentioning. I've just realised I've gone into darkness. The light happened back again. And then we look at the next steps and timelines. So the key finance changes were around Pillar 2 for us, for the outbound payments, the qualifying finance company, and some other smaller items. But to jump, I suppose, into BEPS Pillar 2, first off, and I'm sure many of you are aware of this, the bill did see many welcome changes since the draft legislation that was included in the second feedback statement, the consultation earlier in the summer, that gave a lot of us a bit of a shock when we read it for the first time. But we'll go into some of those changes later on. But just to take a step back and where we are with Pillar 2 now and look at the journey so far. So agreed in principle, minimum threshold revenue 750 applying to large M&E groups, although Ireland has gone a little bit further and applied this to standalone entities where maybe not M&E, but in Ireland have 750 million on a standalone entity. Effectively, that it means that if you are meeting that revenue threshold, you will have a minimum effective rate of 15% in those entities. Ireland has introduced a qualifying mandatory top-up tax, so we will be collecting, Irish Exchequer will be collecting any top-up tax to bring you up to the 15%. That's in line with most other jurisdictions who are implementing the rule. The Finance Bill implements Pillar 2 into the Irish legislation, and it is effective from the 1st of January 2024. What does this mean? So it means you, I suppose, need to start looking at whether you're in scope or not. It may mean financial disclosure or disclosures in your financial statements for 2023, 2024. And it will mean that you will be filing and or paying tax in July 2026 if you are in scope. The content of the rules we're not going to go into in too much depth, except that there's an income inclusion rule, there's an under-taxed profit rule, there's a qualified domestic top-up, and there's safe harbours. There's a lot of acronyms. It's nearly like learning a new language, and if you are in scope, you are going to become, I suppose, a bit intimately aware of what they mean and what they mean for your entities and the larger group. Some of the, I suppose, the basics and how they apply to the asset management industry. So the 750, and some of these are coming through, I suppose, with discussions with clients, figuring out what it means for our clients and either investment entities or asset management groups. So the 750 revenue threshold, so the definition of revenue. And for this, really for us, it's understanding is unrealized gains or not in. It's not clear. I think to be prudent, we are saying to include. We know this kind of means it could be a flip-flop depending on unrealized gains in 1 year or not. To come within the effective for the 1st of January 2024, you must have hit the 750 million revenue threshold in 2 of the last 4 years. So that needs to be looked at a group level and also at a standalone entity level. So if there is one entity that has a 750 million, they've met the revenue threshold, that entity could be subject to an effective tax rate of 15% under the BEPS Pillar 2 rules. My light is gone again. Safe harbors. A lot of work has been done more on corporate entities to see whether or not they can avail of safe harbors, which would mean not as complicated rules in calculating any top-up tax. Probably relevant if your entity has been filing a country CBCR report up to now, and depending on what's included in those reports, you may qualify for the safe harbor and benefit from a kind of less complicated regime for 1 to 3 to 4 years. The definition of investment entity. So there's criteria, 7 criteria to come within the definition of investment entity, and what does that mean? And most of them are quite clear. There's 1 or 2 where around regulation, so the entity needs to be regulated, or the management of that entity needs to be regulated. So that is also an area that we're focused on with clients and trying to understand what is the meaning of that. And if an entity that doesn't need to be regulated, but for some reason has its management is regulated, or the entity that manages it is regulated, what does that mean? If it meets all the other criteria, does it qualify as an investment entity? The other one that's coming up there is the fund of one. So the investment entity needs to be a collective investment scheme. But what is meant by collective, and is a fund of one kind of covered by that, or connected investors in a fund? The qualified domestic minimum top up, this is what gave us a shock during the summer this year, where in the draft legislation that was published as part of the second consultation paper, investment entities, it looked like were in the scope of the qualifying minimum top-up tax, which we expected would be hopefully clarified, and I think the finance bill does that. And I would say that it is kind of as a result of not collaboration, but good collaboration between the industry, revenue, and Department of Finance. And it's quite clear in the EU directive and in the OECD guidelines that investment entities, that their tax neutrality, should be protected. And safe to say that the Irish legislation does. So the qualifying mandatory top-up tax does not apply to investment entities, and that has been clarified. And that's in line with what we would have seen with the income inclusion rule and the UTPR. So I think overall on Pillar 2, it does for our industry, reflect the effective collaboration and consultation process. And I do think the resulting proposed, legislation assists us in the continued development of Ireland as a competitive funds industry, while also implementing Pillar 2 in line with the requirements and the intent of the OECD and the EU directive. So that's just really there. That was the Pillar 2, the investment funds application. It specifically does not include the QTT, which was definitely a welcome result. So moving on from that then, this is just really if you were in scope. what does happen. Not going to go through this in much detail, but what does happen? So you have to take your profit for the financial statements and apply various adjustments that are set out in the Global rules, the Pillar 2 rules, and come up with a tax amount, an effective tax rate under Pillar 2 rules. This effective tax rate has to be brought up to 15%, and that's the top-up taxes, and the qualifying mandatory top-up tax is paid then. So if in Ireland, when you do that, your effective tax rate is below 12.5%, you need to make that top-up tax, and it's cash tax to Irish revenue within 18 months. So it's July 2026 for filing and returns. And this is in line with most of the global fund domicile jurisdictions. One thing to mention, I suppose, when we're looking through, or definitely what I found when you're going through the rules are much more based on accounting definitions, so definitions that are in IFRS or GAAP, and not some of the taxation principles as we would know them. So input from financial accountants, people who are, know the IFRS, know what they mean. So we're working quite closely with our FAS colleagues to understand exactly what they mean when we're calculating any of the effective tax rates for entities that are within scope. And that is all relevant for when you come to the financial disclosures that are required. So in May of this year, the International Accounting Standards Board issued the International Tax Reform Pillar 2 model rules, which included amendments to ISA 12 to clarify the application for this for income tax on the financial statements. So I think the important takeaway here is that if you are in scope, it will impact on your financial reporting, and it will impact on your financial reporting for FY23. The amendments include kind of a temporary exception to the accounting for deferred taxes. So when you go through the calculation, any deferred taxes, there's a temporary exception to that. And then there's disclosure requirements for any of the affected entities to help users of those financial statements better understand the exposure to Pillar 2. And so I suppose there you need to kind of just monitor, know what's required, speak to your financial reporting team and ensure that the required information is either being gathered and being reported, also discussed with auditors in a timely fashion that they are being captured. I think on the next slide we have some of the sample and we can provide that again after the call, or if anyone needs more information on that too. But they are kind of examples of the information we would see being disclosed in next year's financial statements. So I think that's, and it's a very whistle-stop tour of Pillar 2. But I think the main issues are that investment entities, so our regulated funds, should be out of scope. The issues that we're seeing with clients is whether those investment entities have subsidiaries and whether they are in scope or out of scope if the top entity or the UPE is out of scope. Issues we're seeing around that kind of are in relation to, is it orphaned? Is it equity relationship? Is it being consolidated? And it really is supposed to work through each of those nuances to see what is impacted or not. It's a check the definitions, check the accounting standards. If an entity is being consolidated, where is that happening? Is the threshold met? Is there unrealized gains that are tripping up the threshold? Also the fund of one that I mentioned, that is causing some challenges as well, or more workarounds to understand that fund of one in the definition of investment entity, what does that mean? The other would be, so there's a lot of SPBs or Section 110s under some of the investment entity structures in Ireland, and are they themselves exempt now? And they may be, but you also need to consider the standalone entity provisions that were brought in the bill. So if a Section 110 is hitting the 750 million threshold, is it a standalone entity for the purposes of Pillar 2? If it is, then you need to look at what does that mean. So if it's IFRS and accounting under IFRS, it should be minimal, and they should still have an effective tax rate of higher than the 15%. But if for whatever reason they are not following IFRS, or the main one would be where they're preparing GAAP under Irish GAAP as it existed in 2004, and that is causing some calculation issues when you're going through, and the effective tax rate may be a lot lower than the 15%. So that needs to be considered. So if you have entities that are preparing on old GAAP, to look at them. And they are the main issues that we are seeing around assessing Irish structures for Pillar 2, and the issues that are coming up when we're doing those assessments. So with that, I will hand over to Tamara, who will go through some of the other important parts of the finance bill.
Thanks, Sinead. Hi, everybody. So I'm going to go through and provide some more detail on the outbound payment regime that has been introduced and brought in the finance bill. So this is following a consultation during the summer. Perfect. So these are new withholding tax measures for interest, royalties, and distributions. And the introduction of them mean that certain payments that might have been exempt from withholding tax under the current Irish domestic law would not be subject to withholding tax. So the measures apply to payments of interest, royalties, and distributions being made to zero tax or non-cooperative jurisdictions, which for this purpose is the EU non-cooperative list. So the rules only apply to payments to associated entities. So payments to any third party, so be it external debt, etc., would be outside the scope of the outbound payment rules. So broadly speaking, for association for this purpose means kind of a 50% relationship with shares, profits, voting rights, etc. But you can also come in through what's known as definitive influence, which is defined in the finance bill and would be relatively similar to rules that were there for anti-hybrid and ALR as well. So these new rules apply from 1 April 2024, unless the structure falls within the grandfathering provision that is in there. So for arrangements that were in place at 19th of October 2023, the application of the rules is extended until 1 January 2025 to allow kind of some additional time for restructuring. So just briefly, in terms of a flowchart thought process of how this will work. So if you have a payment of interest, royalty, or a distribution by an Irish resident company or a permanent establishment, if you don't, the provisions don't apply. If you do, is it to an associated entity? So as per the definition that's under the finance bill, if it is, then you would look to see if that associated entity is resident in a specified territory, be it one of the zero tax or non-cooperative jurisdictions. If it isn't, either of the two above, the provisions won't apply. If it is, however, you may need to consider further if the outbound rule withholding tax actually does apply to the payment that's being made from the Irish company. So there are a few kind of other important kind of provisions within the new rules, which we're just going to highlight here. So the first one being the corresponding payment provision, which is where the recipient of the payment, who would be in a specified jurisdiction, so one of our zero tax or non-cooperative countries, makes a corresponding onward payment to a third country. So in cases like this, the first payment being made by the Irish company would be deemed to be made to the third jurisdiction in terms of applying the rules. So it's just important to think up the chain as to where the payments are ultimately landing. The second one being partnerships. So there's a provision included to look through to the partners in a partnership for applying the Outbound rules, where each jurisdiction involved in the structure would treat that partnership as look through. The third one then is a provision which is known as the knowledge test. So this is a provision for payments being made on, for example, quoted Eurobonds or wholesale debt, where it would be reasonable to consider that a company is not aware of any associated entities in receipt of the payment. And if that's the case, then you would be outside the scope of the Outbound rules for that payment of property interest. So lastly, then dividends. So the original purpose of this legislation was to avoid payments like these being subject to double non-taxation. So the introduction here is a provision whereby a dividend being paid by an Irish company where the profits have already been subject to tax in Ireland, that dividend would fall outside of the scope of the Outbound rules as well, because the profits have already been subject to Irish taxes. So we'll just briefly go through then some examples. So in this first instance, you have a Luxembourg parent to an Irish company who is also the note holder in this case. So because our Luxembourg note holder, who is receiving the interest payment, is not in a specified territory, that wouldn't fall under the Outbound payment rules, and you'd be back looking at normal Irish domestic law for how your withholding tax would apply or not. Secondly, then we have a situation of a Irish Section 110 company. In this case, it's orphaned, its shares are held by a charitable trust. And you also have the payment of interest via profit participating note to a Cayman corporate company. So in this case then, because your Cayman company is in a specified territory, you would need to consider if that Cayman company is deemed to be associated to your Irish Section 110. If it is, then you might have an outbound payment issue here. And then thirdly, we have a Cayman partnership structure where our Irish company is paying interest via a note to a Cayman partnership, which is also its parent. So in this case, because our Cayman partnership is deemed to be look-through, you would have to consider if each of the partners above are associated to the Irish company, and also if they're in a specified territory, so where each of the partners are located. Those are the facts you would need to look through for consideration on if the Irish company would need to apply the Outbound rules to that payment of interest. So the next change that was introduced in the Finance Bill is qualifying financing companies. So this introduces an interest deduction for certain qualifying financing companies. So these are particularly companies that obtain third-party financing, and then it's onward advanced to direct subsidiaries where there's at least 75% ownership. So important to note that it is only specifically direct subsidiaries of the financing company. If there is indirect onward lending within, say, wider within the group, that wouldn't be covered here. And then also important to note that the loan onward to the subsidiary would need to be used for the purpose of that subsidiary's trade. So the relief in this case then is an interest deduction for the company that has drawn down the external third-party debt for the element of the interest that's being paid to the third party that is directly matched with a loan to a subsidiary. So in that case, then the qualifying finance company would be able to get an interest deduction for that matched amount of interest. So this obviously is a very welcome adjustment because it provides relief where there wouldn't have been one previously, because these companies probably wouldn't have been considered to be carrying on a trade and therefore wouldn't have got any deduction for interest that might have been suffered on third-party loans. And with that, I will hand over to Keith, who's going to run us through some VAT changes.
Thanks, Tamara. Thanks, everybody. Just going to take a very short time, glad here, just on some of the VAT updates. In terms of measures in the Finance Bill, there's actually quite a lot of VAT. this year. However, what's really relevant to our sector is really all I want to focus on today. Some of these you may be familiar with, others are like, as sometimes we see legislation, uh, little landmines sitting around the place we just need to be very careful about. And then there are also some changes coming down the lines I just really wanted to highlight so that they're in the back of everyone's mind and we're preparing for the future. So I suppose with that in mind, maybe the first thing I just wanted to touch on was the changes in VAT registration thresholds. And certainly you'd have heard on your commutes to and from work all the big noise was made about the increase in thresholds and first increase in terms of, since 2008 and how good this was for small business, etc. I suppose the key message I really would like everyone to take home today is that that's completely not relevant for our industry. And for those of you who have experienced this, you'll be aware that in actual fact, for investment funds, for managers, there's a nil VAT threshold. And what gives rise to a VAT registration requirement is the purchase of any services or indeed goods from abroad. And there is no threshold for that. So €1 of a service from overseas will be enough to trigger a VAT registration. So as such, it is extremely rare that a fund or a manager would not have a registration, albeit on a technicality. So just to take that one home, that that there's no comfort to be taken by these changes in thresholds that you might have been hearing about, and it remains as nil. So maybe just to take a quick look at um, your own portfolios and make sure that we're completely compliant on all of that. The second change is one which is one of those little landmines I was just referring to. And it's quite of a technical change, which on the face of it didn't look as if it had any impact. But when you start to look at it a little bit more, you can see that there could potentially be issues. So at the moment, or before the finance bill anyway, the VAT exemption in Ireland referred to the issuing, transferring, or otherwise dealing in stocks, shares, debentures, other securities, so that the issue of these securities was VAT exempt. You didn't charge VAT. Recent European case law, which has precedent here, has indicated that actually, the issue of those shares is what we would call outside the scope of VAT. So again, there's no VAT arising. That's fairly clear, but it has an impact on terms of recovery. So the change in Irish law has been to remove the word issuing, so that for now going forward, the exemption is for transferring or otherwise dealing in stocks and shares. So on the face of it, we would say, yeah, look, that was just to bring Irish law into line with the European cases and nothing to see here. But in actual, when you begin to look at it, there are little things there that could be of issue. For example, the issue of shares is outside scope where it's for raising new capital. So inadvertently, I would suggest that this change in Irish VAT law will have cast a slight doubt over whether things like share for share exchanges, rights issues, those type of transactions, strictly speaking, wouldn't fall within Irish VAT law because the issuing of those now is no longer VAT exempt. I can't for 1 minute think it was intended, because it's clearly, would be against European legal principles. But that's kind of where we're left with at the moment. It has a knock-on effect as well in terms of services of those arranging for the issue of shares, and that we would have relied on another little exemption, an agency exemption that's unique to Ireland further down the legislation that would tie into that. So there's a knock-on impact on some of those services. So at the moment, we're in discussions with Revenue. Have indicated they didn't see any changes to the VAT treatments. They do recognise now that actually that change does give rise to a little bit of a complexity, and so they're considering that. So it's more as I would be surprised if anything changes. I don't think it will, but just to highlight again that at the moment there's a little bit of a wrinkle there, a little bit of concern, and we just need to work through it. So expect further changes, I suspect, is the message that we would give on that one. The final points maybe just to highlight for everyone, I wanted to highlight today is some stuff that's just coming down the line and to be aware of. So I suppose following the success of the PAYE modernisation projects, the next tax that revenue authorities are moving on to is VAT. And what we're now moving towards over the next number of years is a modernisation of VAT. So instead of maybe filing paper returns or returns online, we'll move to a more real-time reporting of VAT. We'll move from paper invoicing to electronic invoicing. Now, by electronic, I don't mean PDF. I mean a standard agreed European standard probably type of invoice that can be interrogated by revenue authorities and would be capable of being integrated into financial systems. There are rules across Europe or provisions across Europe that e-invoicing will become mandatory from the 1st of January 2028. As at the latest, many jurisdictions have indeed started the process and have moved that way. Ireland has announced that they're moving in that direction, and they've opened a consultation process, and that process remains open until the 12th of January 2024. It's an online questionnaire, an online form, where they're gathering views of all industries across the board on this modernisation project to get the impact of industry, which is to be welcomed. We ourselves, of course, will be inputting into that over the coming weeks, and very happy to discuss the impacts and potential impacts on anyone's on your businesses over the coming weeks and years. But just maybe to highlight that Ireland would see that their move towards modernisation has been much more broad and much more all-inclusive than perhaps even the European one. So a move across all industries, not industry specific, across all industries and across all industry sizes. So a lot to be considered and a lot to move and a lot to be very, very exciting. So I suppose the key message I would just maybe say to those at the moment who are involved in sort of finance transformations and IT updates is that we need to retain flexibility for these changes that are coming down the line. At the moment, we're aware of broad brush what they might be in terms of what they hope to achieve, but the actual detail around all of that is something we wouldn't have just at the moment. So it's to build into those projects, which can be over a long period of time and multi-year and multi-platforms, is to build flexibility into the process and to build these changes into planning for those, so that we remain agile and flexible as more detail comes out over the next number of years. So I think, Sinead, Tamara, that's really it from a VAT side for now. I say quite a lot happening, so maybe if I hand back over to let you wrap up for them.
Thanks, Keith. Just wanted to mention two other things that I suppose will impact on investment entities in the finance bill, and one of them was around a technical amendment to the definition of entity for the hybrid rules and the reverse hybrid rules. So when came in for this, really is for collective investment schemes that are set up as trusts and not as corporates. And it's to tidy up. We got it in guidance last year, and this now kind of confirms that position, that a collective entity scheme, the hybrid rule shouldn't impact it. You can treat it as a collective investment scheme for the purposes of the hybrid rules. And similar, but on the FACA CRS, up to now, where there was an entity that had no legal personality, so a partnership or a trust, including a unit trust of the collective investment entity, FACA CRS or DAC 6 penalties could not be levied because they weren't a chargeable person. So the legislation has been updated to say that a partner or a liable person or a management company or a trustee can be liable for penalties in connection with FACA CRS. With DAC 6, they have amended the framework so that they can have joint audits and revenue powers when they are looking at inaccurate information that's reported through DAC 6. Sorry, excuse me. Also, just wanted to mention what's not included in the finance bill So the worldwide system of taxation, which would improve Ireland's standing as a fund industry, especially when it comes to the ILP. So the bill doesn't include legislation to include a territorial system of double tax, but the Department of Finance has confirmed its intention to include a participation exemption for foreign dividends in Finance Bill 2024. And this is definitely a welcome introduction. And the consultation process for that is currently ongoing. The introduction of a foreign branch profits exemption remains under consideration. The other thing to mention is ATAD 3, which I know when it was introduced did cause a lot of noise in the industry and what it would mean for a lot of entities that have outsourced activities. This kind of pops its head up every now and again, but there has been nothing recently, or they kind of at an EU level, and nothing in it included in the finance bill. Yeah, nothing to see there, but it's still watch and see under the Spanish presidency at the moment. They have it's still on their radar, but we haven't seen anything further on it. Tamara, you were going to go through the remaining two.
Absolutely, yeah. So on the last two there, the BEPS and the TP directive. So on the 12th of September, just passed, the EU Commission issued two proposals for those two directives, and they're now going to move into negotiation phase between all of the member states. So the first one, the BEPS directive, aims to introduce a common framework for tax-based determination and basically an aggregated corporate income tax rules across the EU for in-scope multinationals that meet a certain threshold. So that is aimed to be introduced and effective from 1 July 2028. And the latter one then, the TP directive, which is intended to codify in the OECD principles and guidance on TP into domestic laws of the member states. And it's also intended to provide clarifications on processes to make sure that TP is aligned in terms of admin and picking up of taxes in order to prevent double tax across the member states also. And that one's looking to be effective from 1 January 2026. Do you want to?
Okay, great. So before we go into that, I was going to see, was there any questions? Because we're coming near, or to signal to people if they want to put in any questions to do so. So no, there's none there yet. So this is the next steps in the timeline for the finance bill to be implemented into legislation. So committee stage, I think there has been the first of the committee stages, I think on the 6th of November has occurred. A few amendments have gone through on that and they're published on the government website. Nothing of note and nothing to what we were talking about today. Then it'll go to the report stage, the Senate stage, and the President signs the finance bill towards the middle to end of December. So a lot of these will be effective from the 1st of January 2024. So while there's a lot in the finance bill and it does change how we kind of look at taxation, one of my main takeaways is tax is changing and it's increasingly getting more complex. We're seeing a lot of changes coming down the line. Tamara, you talked about the BEPS and the transfer pricing. ATAD, there's a lot on the EU agenda as well as the OECD. How this all interacts internationally and with other jurisdictions is also something that we're keeping an eye on. I do think this whole process around Pillar 2 and BEPS and its implementation, it was really positive to see the consultation that did happen and the understanding, I suppose, of the Department of Finance and the intention of the government to kind of protect the Irish funds industry. And that has also been kind of reinforced by the consultation funds 2030, the importance of the industry to Ireland and to the Exchequer. And I think I would take that they are trying to implement the new tax regime and give consideration to the nuances of our industry here in Ireland and ensure that it remains competitive, and we're not doing anything that would put us as an outlier to any other jurisdictions, and would take it as a positive direction of travel for our industry. And with that, I'm just going to check once more if there's no open questions. No, if there are questions, feel free to email anyone on the panel here. Happy to go through in more detail. I know it was very high level. And with that, I will thank you for joining and give you back 20 minutes of your hour. Thanks again.